Good afternoon. We're going to discuss one problem in the end of the chapter 8-3 of the book Accounting Texts and Cases. And we will read it. For each of the following situations, the present value concept should be applied. Your wealthy aunt has just established a trust fund for you that will accumulate to a total of 100,000 in 12 years. Interest on the trust fund is compounded annually at an 8% interest rate. How much is your trust fund today? So the present value here is trying to get what is the expected amount of value today of that amount that you will receive in the future. So your aunt is going to give you 100,000. Okay, 100,000 at the end of 12 years, 100,000. So how much of that will be here? 12 minus, okay, and minus 12 years. Okay, 12 years, 100,000 we will receive at the end of 12 years. And how much is the rate? The cost of money involved here is 0.08. Okay, so how much would that be? Is that all that that we need? If I were to compute this, it's going to be 100,000 times the present value. Okay, I told you that this is using the calculator is a very handy way to calculate for present value. So we start with 1 plus 0.08, and then you have to press divide, equal. Okay, and then now we press for 12 times. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. So we are given 0.39711. So that is the rate that I will apply here. 0.39711. So that's around 0.34. So that is at now 39,711.34. So the money that I will receive, 100,000 after 12 years, is actually right now at 8%. Is actually right now 39,711.34. You can actually check that if you were supposed to receive now 39,711.34 and you would invest that at 8% interest, how much would that be after 12 years? Again, with the calculator, now using the future value, I will just get 1.08 and I press times twice, okay? And then that is already my first term. 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 11 is that 2? 2.5. We're supposed to get 2.51816. 96 times 39711.34. That's 100,000. Okay, I'll do that again. I should actually get the 12th year. Okay, so 1.08. This is I think this is the second year already because the first year is 1. So this is 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. So that's the amount, 2.518. Okay, so this is the future value. If I were supposed to get, the question is just this one. So I'm just telling you the way to check it. If I were to receive 100,000 in 12 years and the interest rate, the cost of money is 8%, then I calculate for the present value and 12 years, 8%. So this is the factor that I got. This is the amount. So is that correct? Okay, we can check it. If I were to have money right now, 39,711.34, and I would invest that, yeah, compounded annually at 8%. So what is the factor that I got? Future value. I multiply it, 12 years at 8%. This is the amount that I got 99,999. Okay, so basically this is the answer that we have. Okay, so now let's go to 8-3, but the second question here. Again, we have to apply the present value. On January 1, you will purchase a new car. The automobile dealer will allow you to make increasing annual December 31 payments over the following years. The amounts of these payments are 4,000, sorry, 6,000. These are the amounts of payments every December 31. At the end of 1 year, December 31, 2 years, December 31, third year, December 31, fourth year. Okay? And you purchased the car January 1. On the same January 1, your mother would lend you just enough money to enable you to meet these payments. Okay, so January 1, you're going to purchase a car. This is X1. Okay, the question is, how much would your mother lend you so that you will be able to get to pay this? You will be able to meet these payments. How much would your money right now be? And invest it so that there will be enough money for you to pay every time. So this is a series of payments. Interest rates are expected to be 8% for the next 5 years. Assuming that you can earn annual compounding interest by depositing the loan from your mother in a bank, what is the minimum amount your mother must loan you to enable you to meet the payments? So this is a question you cannot add everything. This is not just one principle. You cannot add everything and then just get the present value of the total of that amount for 5 years at the rate of 8%. You cannot do that because this is the amount that you need in year 1, year 2. So what you have to do is really just get the present value of each amount, okay? And then add them all up to see how much do you need for your mother to lend to you, okay? So we will start with 4,000. So again, I use my calculator. The present value at, this is just end of 1 year. This is 1 year, 2 years, 3 years, 4 years. Why 1 year? Because 12 months have passed. Okay, so this is 1.08 divide equal 0.925. Is that right? 0.925 multiplied by 4,000. I have 3703.70. 1.08, I press division twice, equals. This is first year, we're done. Second year, 0.857 times 45, 3858.02. And then now, is that 5,000? Okay. Again, 1.08, we're going to the third year. Twice, you press division twice, and then equal. Okay, so that's the first year, second year, third year. 0.7938, that's the present value, multiplied by 5,000. 3969.16. Okay, now for the last one, again, 1.08 twice of the division equals, and then 1, 2, 3, 4. 0.735 multiplied by 6,000. That's 15,941.06. Okay, so that is your answer. Okay, so let's not erase the board yet. I'm just saying that this is 8-3, 2. Now we will go to 8-3, 3. right? Okay, so what is the question for 8-3, number 3? In settlement of a claim for your recently wrecked car, your insurance company will pay you either a lump sum today or 3 annual payments of 3,100 starting 1 year from now. Interest rates are expected to be 6% for the next 5 years. What is the least amount of money that you should be willing to accept today? Okay, so the interest, so we're supposed to receive money right now, lump sum. This is option 1. Or B, we're going to be receiving end of year 1, end of year 2, end of year 3. And the amount is 3,100. And the interest will be 6%. Okay, 6%. So what are we, the question is, are you willing to receive money today or installments of 3,100 at the end of every year? This is today. This is year 1 today. And then the end of year 1, you're going to receive 3,100, end of year 2, 3,1, end of year 3, 3,1. So what we're going to do is get the present value of each payment. So that will make the two amounts comparable. Yeah, the amount of money right now, no need for present value, is just the money now. So you have to get the present value of all of these payments to find out what are you willing to accept now, which is also the same as if it were by installment. Okay, so let us compute. So remember, we're getting the present value. The amount is, I mentioned 6%, 1 plus 0.06, twice the division equals. The first one is 0.943 multiplied by 3,100. That's 2,924.53. Okay, again, 1 plus 0.06 equals divide equals. That's the first one that we had. Second is 0.8899 multiplied by 3,100. That will be, the amount we will receive in year 2 is actually right now worth 32758.99. And then again, year 3, 1.06 divide equal 123.8396 times 3,100, 2,602. Okay, so answering the question, what is the least amount of money that you should be willing to accept today? So getting all the value of all of this at the end of each year, we have come up with a present value. So I'm willing to accept right now 8,286.34 right now, because it's simply equivalent to receiving 3,100 at the end of each year at the interest rate of 6%. Okay. Okay, do I erase the board? I think I still have some space. We are going to do question 8-3, 4 here. I hope you can still see that. So let us read the question. What is the present value of 3,000 a year to be received in years 3 through 11, assuming a 12% discount rate? Okay, what is the present value of 3,000 a year to be received in years 3 through 11, assuming a 12% discount rate? So this needs a calculation that is there in the book. I will just show it when I'll just show it to you. But the way that I calculate it is we're talking about, so this is the time period. And then this is the present value factor that we will get from Appendix B at the end of the book or the ebook that you have there. Okay. And we're supposed to get years. What is the present value factor? Years 1 to 11 less. We will reduce that. I think that is less years 1 to 2, so that we get the difference, which is 3 to 11. Okay. So I think if you have, this is 1 to 11, you wanted to know from here, what is the question? What is the present value of the amount that you will receive from 3 to 11 if the interest rate is assuming a 12% discount rate? So you cannot calculate that unless you get the entire thing minus this. You get the entire thing minus this would be this amount. Okay? That is the reason why we have to get the present value factor 1 to 11 and reduce it by years 1 to 12, 1 to 2 in order to get the present value of 3,000 you will receive through years 3 to 11. Okay? So how do we solve that? We have the present value. Can I show you? Share screen. Appendix B. I'm not seeing it. Okay, am I seeing it? Okay, so it's something we have to look. We have to use the table that is present value of $1 received annually for N years, because this is exactly what we have to, this is what we are asked. Present value of 3,000 every year, assuming a discount rate of 12%, 3,000. So 12%, we have to get 11 years. That is 5.937. And then 11 years up to 2 would be 1.690. Okay. 4. 8 minus 6 is 2. 5 minus 1 is 4. Okay. And that one, you have to multiply it by 3,000. So the value of that 3,000 received for, the value of the 3,000 received through years 3 to 11 would be 3,000 times 4.247 is equal to 12,741. Is that right? 3,000 times 4. 12,741. Okay. So I hope you right now you understand better how is it to get the present value of some amounts you will be receiving in the future. This can be earlier, the first question that we had is like 100,000 I will receive in 12 years. How much is that right now? So you get the present value using the interest rate and the number of years. Okay, and I showed you that I'm so reliant on the calculator, but at some point we really needed the table. Okay, so I hope you understand it better right now. With this, I'm just emphasizing that how can you decide on items that are quite different? A lump sum money right now and 3,100. How can you make a decision on two sets of numbers that are different? So what you have to do is get the present value of all of these payments so that you can say, okay, the minimum money that I need right now is 8,286. Okay. So with that, I think that is the only thing that I will discuss in chapter 8, which is entitled Sources of Capital Debt. The others could be a little bit more complicated. So that is the only one that I think you need to understand when it comes to getting the present value of money. So 8-7 says, I don't think we will be able to have time to answer everything, but let's see the first one. During the year, Shore Company issued several series of bonds. For each bond, record the journal entry that must be made upon the issuance date. So we're only required the issuance date. This is the easiest, March 15. I think we can answer this, but then the other two, I'll just give you some principles. So on March 15, a 20-year 5,000 par value bond series with annual interest of 9% was issued. 3,000 of these bonds were issued at a price of 98. Interest is paid semi-annually. Okay, so which means that these bonds have been issued at a discount. No, so there is a bond discount. At 98 means 98% of the price. Okay, so we will solve it as follows. Because we have issued a bond, there is, if this is a debit, this is a credit, we have to debit for the cash that we have received, and then bond discount is discount is something that is deducted from bonds payable, so it goes against a liability, so it will be debited. Okay, so how much is the amount? It mentions 5,000 par value times 3,000. So that's 15 million. And then for the amount of cash that we receive, it will be 15 million times 98%, 14,700. So the discount is the 2%, which is 300,000. Okay, that easy. We are not, okay. We are not asked for any entry on the interest. This is March 15. We're supposed to pay interest semi-annually, so June 30. And no, after 6 months, every 6 months. Okay. And then we will not be able to compute anymore. I think I have seen different answers, but the important thing to remember here in 2 and 3 is that there could be a premium and a discount. How would you know if bonds were issued at a discount or at a premium? We have to compare it with effective interest rate. We have to compare the interest rate of the bond, what we are willing to give to our creditors. As regards, we will compare it with what is there in the market. So in number 2, annual interest is 8%, but the current yield to maturity is 6.5%. Okay, so we are going to sell this at a premium, yeah, because we are willing to pay 8% and the market is only at 6.5%. And then here, number 3, on October 3, a 10-year 1,000 par value bond series with an annual interest of 7% was issued at a price to give a current yield to maturity of 8%. I'm willing to give at 7%, the market at 8%, so I could only sell the bonds at a discount. Like to really get the creditors to invest in me, I have to offer a certain, I have to offer my bonds at a lower price. Okay?